Hello, everyone. Thanks for being here today for our special webinar on CERM Sandbox, a new way to assess climate-related financial risk. I am Olivier Vinciguerra, Chair of Green RWA and your host today. We are delighted to present you with our collaborative work that provides an interactive experience to explore and manage climate-related financial risk of the banking book in a simple and accessible manner. This tool is freely accessible. It is something that is close to our hearts within the association. It's important for us to share our research and knowledge with the entire financial community. I would like to thank Finastra, our corporate member, one of our corporate members, I should say, for their significant contribution to the development of the sandbox. Before we begin, allow me to make a connection with an article I read this morning in the Financial Times titled "Financial Models on Climate Risk Implausible According to Actuaries." It highlights the financial institution when using models to predict the economic cost of climate change. The article emphasizes the disconnect between climatologists, economists, model designers, and the financial institution that use them. As a matter of fact, if you look at the results of the different stress test exercise, they're not so worrying. Whether it's true or not is yet to be determined, but this is a fact. It also highlights a study, by the way, by the actuaries that reveals financial institutions underestimate climate change risk by using implausible models. Companies are required to report their climate risk and emission, but some models inadequately communicate these risks. In this context, our event today on CERM Sandbox holds particular significance. We're exploring a new approach to assessing climate-related financial risk. We aim to provide a more comprehensive tool for evaluating these risks. I'm confident that this event will deepen our shared understanding of financial risk related to climate change. So it's with great pleasure that I introduce our two speakers today, Shirin, the Head of Innovation at Finastra, and Jean-Baptiste Godmet, co-founder of Green RWA. I encourage you to actively participate by asking your questions after the presentation by Shirin and Jean-Baptiste. And with no further ado, I will let Shirin introduce Finastra. So this was the couple of facts about Green RWA. You can find that online, but let's move to Shirin now, please, Jean-Baptiste.
Working and collaborating with Green RWA, we are one of the proud corporate partners and members of the associations. For those who don't know Finastra, so we're one of the largest fintech companies. We build software and solutions for banks across the 5 verticals that you see in the slide. So lending, payments, universal banking, capital markets, and platform. And what we really saw in the recent period is an increasing appetite from our clients for everything green and sustainable finance. And that translates basically into transforming the solutions and the software that we provide to them that helps them operate in this space. And I wanted to share with you just a couple of examples there. So if we take the lending as one of the verticals there, everything commercial loans, syndicated loans, structured loans, we see an increase in terms of everything green lending activities, sustainability-linked loans, and that all goes with an increasing demand for adopting the solution and the technology. So being able to capture the ESG KPIs with the green APIs at the origination time, but also to continuously monitor all of these data and possibly build analytics on top of that. So that's one of the areas of focus that we work on at Finastra. On the other side of the spectrum, on the capital market space, a very similar use case is everything green bonds and sustainability-linked bonds as well. And a recent number from Bloomberg was saying that it's the volume of green bonds has finally exceeded the volume of bonds in the gas and oil industry. So definitely increasing there, and of course, again, solutions and software need to offer the right platform for banks to operate in this space. And the third example, which would be our area of focus today, is everything enterprise risk. So managing the financial risk. You might be familiar with the standard frameworks to manage credit and market risk. These frameworks today need to be extended in order to manage, to capture and to monitor climate risk. That's where the CERM comes to play. And that's why we are really excited about the collaboration with Green RWA here in order to be able to build a future-proof risk management tool that captures climate risk and allows for a smoother transition into greener banking portfolios. So with that, I'll hand it over to Jean-Baptiste to take us through the CERM model and the sandbox as well.
Here we are. Thank you, Shirin. I hope you are all hearing well and can see my slide. As Shirin introduced, I mean, the idea of the CERM is to extend the existing regulatory risk model around credit risk by integrating a new risk factor coming from climate change. Our purpose with the CERM is to offer a kind of mathematical framework to the banks and the regulators in such a way that it will be possible to publish, report, and disclose climate extended metrics. And what we want with this framework is also having the possibility for the banks and the customer of the bank to assess the sustainability of their net zero transition plan under a context where we will be suffering from a non-stationary climate risk factors in the next years and decades. That's a very important point. We'll see it later. I mean, the CERM is designed to be long-term, multi-steps, and forward-looking in such a way that we can capture the non-stationarity of the climate risk factor, and we can integrate in the model the strategy of rebalancing of the bank, as well as a transition plan of the customer of the bank, meaning the borrowers. In order to facilitate the financing of the transition plan of borrowers, it's also essential for banks to be able to price what is often called on the market the greenium, meaning the bonus banks can offer to their customer to finance their transition project. And the CERM model is also designed in such a way that you can derive mathematically the risk reduction the banks will get by financing such a transition project in such a way that you can have a proper quantification of the value of this greenium. And by the way, vice versa, the CERM allows as well to quantify the malus banks should apply to their loan in case they are financing an activity which is not aligned with the transition. So we offer basically a framework to have a kind of a bonus malus spreading on loan in order to provide the right incentive to the market to allocate capital towards the transition, considering the fact that it is a key factor to mitigate the cost coming from climate change. So the CERM is an extension of the regulatory IRB model, but it's also complementary and fully consistent with the climate stress tests banks are already doing, already asked by the regulator. In fact, to run the CERM, as we are going to see in the demo, you need 3 types of inputs, and 2 of them are exactly the same than with the stress test. First input is the banking book. Obviously, I mean, the risk is must be specific to the banking book of any bank. So you need the banking book of the bank, but not only that, you need information about the transition strategy of the bank. So how the book will rebalance year after year. That's a key difference with traditional risk. Here we are considering a long-term risk, and therefore it's a risk which goes beyond the typical maturity of the lending book of the bank, and therefore it is essential to take into account the rebalancing strategy of the bank and the trajectory the banks will follow to transition toward a net zero situation. So in that sense, as we are going to see, the bank strategy really plays a hedge, a role against climate change, effectively. Second input we need for stress test and the CERM is the situation of the borrowers, which are the customer of the bank and the source, obviously, of credit risk. On the borrower side, obviously, you need information about their climate exposure, and that's not an easy task. I mean, banks are spending a lot of resources, collaborating with the ecosystem of data provider and platforms to collect relevant information to assess the exposure of borrowers against transition risk and physical risk. So they need information about the carbon emission, for instance, scope 1, 2, and 3, and they also need information about the asset localization, the physical asset localization of their customers in such a way they can assess their exposure to climate-related events. But it does not stop here. Again, on the climate stress test and on the CERM, we are considering not just the short term, but also the long term. So it is essential to factor in the model the transition plan of the borrowers. So all the investments borrowers are doing either to mitigate their carbon emission or to adapt themselves to climate change. And by the way, this transition investment can be funded by the bank. And that's where we have a very positive feedback loop. Thanks to the CERM model, we have the possibility, as I said in introduction, to calculate this greenium, so this malus bonus, in such a way that we facilitate the financing by the bank of the transition investment for the borrower. The third input we need on the CERM, which is designed not just to calculate specific stress tests, but which is designed to calculate the unexpected loss, meaning that we need to calculate the full Monte Carlo distribution of credit loss of the book, is a stochastic model. On the current IRB model, this stochastic model is actually very simple. There is a single risk factor, which is the economic risk factor. And because the economical risk is considered as stationary, this risk factor is typically calibrated by the regulator with an historical approach. We observe historically the economic cycles, and that used by the regulator to define the intensity of the economical risk. With climate, we cannot anymore have a backward approach. We need to have a forward-looking approach, meaning that we need a dynamic diffusion model to model the evolution of transition risk and physical risk moving forward. And what we want is to have a model which will also be able to capture correlation between physical risk, transition risk, and economical risk, as well as we are going to see, autocorrelation, reflecting the fact that climate change has, by nature, a big inertia. So that the third category of input is the systemic risk factor, which allows again to have a full Monte Carlo distribution of the credit loss, from which we can not only calculate the expected loss, but also the unexpected loss, considering a specific confidence interval. I mean, in the graph here, you can see using two examples, 5% and 1%. So just again, I mean, to reemphasize the relationship between the unexpected loss model and the stress test, you can think the stress test as being one Monte Carlo pass on the full distribution. So in fact, with the CERM, we are taking the stress test and we are completing the credit loss distribution. So we are completing with by generating a very large number of stress tests in such a way that we can quantify the size of the tail and calculate the unexpected loss. The unexpected loss is something very important in the financial risk, because that's what cannot be covered by a bank, and because it is the tail risk of a systematic factor, so we cannot hedge it. And therefore, that's typically the metric which is used by the regulator to assess the amount of capital the banks should carry on their balance sheet in order to be able to survive to an unexpected loss. And that's a very important metric, and the capital charge is typically driving the profitability of the bank, and therefore a key factor for the pricing of a loan. Hence, the fact that with our model, we can calculate this gremium pricing. Having said that, I would like, and I'm very, very happy, very proud to present you a demo of the sandbox, which is publicly available, and we have developed in partnership with Finastra. So let me stop sharing here and reshare the sandbox. Some of you may have seen it. So what I suggest is we start by running the simulation, and it take a few times to get the calculation done. So the sandbox is a simplified model. We have simplified a little bit the equation, and more importantly, what we will consider here is a single portfolio, which will be modeled at its average. So that's obviously very simple. In reality, banks will build up several groups to structure their portfolio, and each of these groups will be modeled at their average. But that requires a bit more calculation and a bit more sophistication. So for the sandbox, we have something very basic, but which allows to understand the mechanic of the model. So let's start with the modeling of the portfolio. What we are going to do here is to have three portfolios. In fact, one initial portfolio, which is the current situation of the bank. That's something you can observe by looking at the banking book. But not only that, we're also going to have the target portfolio, which is where the bank wants to be at the transition target date. So here we consider a transition target date at 2050, so in about 27 years. That means the bank.
If I may, Jean-Baptiste, we don't fully see the x-axis. So the time horizon, I believe.
On the graph.
I don't know if it's on your. Yes, perfect.
Yeah, but I will scroll on the graph. So far,
perfect. You're on it.
So far,
I know you're on the left-hand side, but okay.
Yeah,
I was
so
just attracted by the graph.
So we have this transition target, which is 250. That means the bank consider that has a strategy to move from this initial portfolio to this target portfolio in 27 years. Each portfolio is defined by three metrics, which are the average of the portfolio. First metric is the rating. So here is BBB. Obviously, in reality, the banks, we have various buckets, but again, here I simplify with just one group, so BBB. And then I have two metrics to summarize the exposure of the portfolio against physical risk and transition risk. So in my example here, I will assume that my portfolio has a physical risk of 1, meaning that it is equivalent to the global economy. 1 means the average of the global economy. So I have a portfolio which is aligned with the average situation of the global economy. However, on my transition exposure, I have a portfolio which is at 2.5. That means it is 2.5 times more exposed than the global economy. That means there is a very significant skew on that portfolio towards companies which have a very high carbon emission, and therefore will suffer much more than average of, let's say, an increase of the carbon price. So that's really the problem I have as a bank is on the physical risk is kind of okay, even if it can be better, but on the transition exposure, I have clearly a very high exposure, and that's something I want to change by rebalancing my book towards a situation where I don't change the target rating, so I don't change my policy in terms of expected credit risk. However, I want to rebalance towards a situation where I divide by 2 my exposure to physical risk, and I divide by 5 my exposure to transition risk. So I want now to be half less exposed than the global economy to climate change. In order to do that, I have two possibilities, in fact. One is to rebalance my book towards greener activity, or to finance my customers, to finance the transition plan of my customers in such a way that their exposure decrease over time. Okay, so in the sandbox, we aggregate those two factors, but in real implementation, very important to distinguish what is coming from the bank effort, rebalancing toward greener activity, and what is coming from the transition investment of the customer, which can be funded by the bank. Okay, so that would be my two portfolio. From here, I need to have a stochastic diffusion of what we call the macro correlation, which is a global evolution of the risk factor. As I said in introduction, we cannot anymore have a backward approach. We need a long-term, forward-looking approach. And for that, we have put in place a set of equations which described how physical, transition, and economic risk factor are going to potentially evolve moving forward. I say potentially because it's a risk model, so we are always considering a distribution, and we have a Monte Carlo simulation. So first of all, I define the horizon of my model, which is 50 years, and then I have a set of parameters which can be adjusted and can be adjusted in order to fit with the stress tests which are already used by the bank. So it's possible to make sure that the full distribution is consistent with a selection of stress tests which are already used either from the IPCC or others by banks. So the factors are, first of all, what I call the physical risk acceleration. So here what we say is because carbon accumulates on the atmosphere, the model is not going to consider the speed of climate change, but it's going to consider the acceleration or the deceleration of climate change. That's a very important stuff, and that's what we introduce inertia in the model. That means to turn around, it takes a long time because you need to move from acceleration to deceleration, and that's only at this point that you can potentially turn around. It's like in physics, when you have inertia, the only thing you do is to apply a force which has an effect on the acceleration. So here what we consider is every year, 10% of the typical economic risk will either speed up or slow down the evolution of climate change. Again, we are working here on the acceleration. So that means we accelerate or decelerate by 10% of a typical economic risk. Second thing I'm going to do, so here it's a variance model. So it's either up or down on the acceleration. Here it is the expected model. So I consider here that the current credit rating, which is controlling the expected loss, do not fully reflect the reality of climate change. That's a statement, obviously, because you may say that credit agencies are already integrating the climate risk on their credit rating, and therefore it's already capturing the climate risk on the resulting expected loss. But you can also say that this is only partial, and therefore you can consider that a portion of the variance will impact the expected drift on physical risk. So zero means that you consider that everything is on the current credit rating, and here we have a halfway approach where I consider that it's just half, which is already included, and half we need to add on top of what is already captured by the credit rating. And then on the equation, we obviously consider the possibility to do a transition effort. I mean, we have kind of a positive approach in a way that we consider that there are technology on the market which have a transition efficiency. And therefore, it's possible to invest on this transition technology, and this will have an impact in terms of decelerating the climate change. And the return of this transition investment is captured by this factor. You consider that each time you invest 100 euros in a transition, you will get 8% in terms of deceleration of the cost of climate change. This 8%, I calibrated with a very small soft process. If you assume that the cost of doing the transition is about 7 trillion, which is 6.25% of the GDP. And if you assume that today climate change is already costing every year 0.5% of GDP and accumulates, then by dividing 0.5 by 6.25, you get 8%. In the current model, we consider this return as fixed. Obviously, it would be interesting to have a dynamic return, considering that the efficiency of transition technology is going to improve as we increase the investment in transition, because we have some scaling factor, which means that it will get better and better. It's not completely obvious. If you look at the windmill, obviously, then first you put windmill where there's a lot of wind, then progressively there is less and less space for windmill, and therefore the return on windmill may decrease. So there is a kind of a competition here between the efficiency of the technology and space available for windmill. And again, today we consider that the return is flat, but you can have a more detailed approach to model the return on transition effort. The last thing we need to do on the model is to define how much we are going to invest in transition, and that's what I call the transition reactivity. So we say here that each time we suffer of $1 more because of climate change, we are ready to invest 25 cents in transition. So that we have a very pragmatic model here. We consider that we do not anticipate, and transition happen only when we suffer from climate change. So in a way, it's a conservative approach, which makes sense from a risk management perspective, but we still consider that globally speaking, as we will face more and more the challenges of climate change, we will be more and more ready to allocate a portion of the GDP toward transition. Okay, so that's the factor. So now let's rerun the simulation because it has been stopped. So as the system calculates the Monte Carlo, and just present the first two graphs here, which tells you the breakdown of the three factors of risk we are considering. Economical risk, which is flat, because it is a stationary risk. Again, that's a regulator approach. It's a backward-looking stationary risk. And that's physical and transition risk. And you can see the model properly reflects the fact that it is a dynamic risk, which is going to increase over time. Second graph we have here, it is autocorrelation. I mentioned earlier that a key element of climate change, due to the fact that carbon accumulates in the atmosphere, is we face inertia, where the climate has changed. It's not going to come back to the initial state easily. There is inertia because you have carbon in the atmosphere, and it's not going to get away easily. From a mathematical perspective, on the risk model, inertia is translated in terms of autocorrelation, meaning that when you are in a very bad scenario, you remain on the very bad scenario for a long period of time. And that's what you can observe with this curve, where you can see that to decrease by half a bad situation, you need more than 20 days of effort. So that's reflected on the model. Then have a look to the results, which is important. So first of all, let's have a look to the initial portfolio. So the initial portfolio was very bad in terms of transition risk, as you may remember, on 2.5, so 2.5 more exposed than average. And as expected, the distribution of loss is very bad, meaning that you have a very, very long tail, even some scenarios where you lose everything, so it's a pure catastrophe. And obviously, the value at risk and therefore the unexpected loss is extremely high. In case the bank is doing and the customer of the bank are doing nothing and just keep rolling. Here you can see the evolution. So that's the cumulative figures, and here you can see the evolution of this figure from 0 to 50 years. So you can see that how the two different level of confidence, 99% and 5%, and you can see how year after year. The unexpected loss of the banks is kind of skyrocketing and blowing up, and that's actually not sustainable for the bank. That's the reason why the bank had put in place a transition strategy. So if you look at the target portfolio here, it's much better. You can see the tail is much more reasonable, and the curve is also much more reasonable. In reality, the bank is not yet on its target portfolio. So there is a transition path which has to be put in place over 27 years. So what matters effectively for the bank is to observe the transition portfolio, which is progressively moving from initial to target. And you can see you are somehow in the situation in the middle, where it's not as good as the target portfolio, but still much better than the initial portfolio. And if you compare the two, you can see that we managed to shift the expected loss on the left, but more importantly, we managed to shift quite a lot the value at risk on the left, meaning that the overall the unexpected loss is much more reasonable. We can observe a comparison between those portfolio in this two aggregated graph, where you can see in green the target portfolio, in red the initial portfolio, which is the worst, and in blue the transition portfolio. On the left is the expected loss. On the right, it is the unexpected loss. So what is really important for a model is the unexpected loss. And you can see that, again, the green is quite good, the red is proper catastrophic, and the blue is starting bad, but because the banks is doing the effort, either by rebalancing the book or by financing the transition investment of their customers, you can see that we manage to progressively curve the slope of the curve in such a way that we come back to the green situation on the long term. And we see the value, the difference between the red curve and the blue curve is a proper quantitative assessment of the value of the transition strategy of the bank. And that's really what we want to achieve with this model, is to offer the banks the possibility to quantify the value of their strategy, either their rebalancing strategy or their financing strategy of the transition plan of their customer, in such a way that they can see their strategy as a hedge against the evolution of climate change. On the long term, it does not make sense to only hedge with capital. It makes sense, maybe we need a bit of capital, but more importantly, we need banks to have in place a meaningful transition strategy in such a way that you can have a very big reduction from red to blue of the risk coming from climate change, either physical and transition. And in order to make that practical, what you can do from this model is to calculate the marginal impact of a loan. So marginal impact of a loan will marginally change the average risk. And therefore, you can calculate the increment benefit of having a green loan in the portfolio. And from this increment benefit in terms of risk, you can derive the greenium you can offer to your customer to finance the transition investment. And all of that remain fully consistent. So between the risk, the stress test, the transition strategy of the bank, and the way you price the green loan to your customer. And that's really the purpose of the model, is again to offer proper economical, quantitative incentive in such a way that the financing capacity of the banks gets shifted toward the necessary transition of our economy towards a net zero situation. Thank you very much for your attention, and I will be very happy now to answer your question. If you have asked a question on the chat, maybe Walid, you can let me know.
Yeah, I think, thank you, Jean-Baptiste. I think there is a question, Jean-Baptiste, you can, I don't know if you can access it, about the difference on the output if the bank finances its clients' transition versus the clients transitioning their own.
Yeah, so as I said, indeed, I mean, here we are simplifying the story by aggregating one single target portfolio, the result of both the rebalancing effort of the bank and the transition investment of the customers. In the proper implementation of the model, and we are working with some partner on that, we will have a situation where the portfolio of the bank will be breakdown in groups. which represent a sector. So not an economical sector, it's a climate sector. So the group will be kind of homogeneous in terms of their climate exposure. And then you have two drivers. One driver is each group will have their transition strategy. So each group will become greener. And on the banking side, the banks will decide to rebalance some of their balance sheet from the worst group towards the best group. So we work at two levels, improvement of each group and rebalancing across the group, which allows to properly reflect the two ways we have to reduce climate risk. Does it answer the question?
I think it does, Mohamed. If it does, I mean, in the nutshell, I think we could say that it's probably the answer is probably no here. And there are other questions before we move to the TR to Boris and Scott's question. Is there another form of autocorrelation if the bank does finance the transition? Although I'm not sure about what you mean here, Mohamed, by your question. If you want to pick the mic, feel free to precise your question.
Yeah. Hello. Thanks for the presentation. It's great. I've been working a lot with the CERM model, so it's great to meet one of the generators of it. My question here is, I saw you talked about autocorrelation here. So if you're in a bad situation, and then that's gonna push you more to stay there. So my question is on the other side of autocorrelation. So if the bank is financing that transition, so is there autocorrelation between that transition happening? So the client move into a greener space and then the bank contribute into it. So because the bank itself is financing that kind of move towards the greener state. So, is that clear? Or
maybe I can answer and let me know if I answer correctly. So
okay.
Correlation is a concept which makes sense at the macro level.
Okay.
It's very important to distinguish the micro and the macro. The macro level is the planet globally. And here what we say is because there is carbon in the atmosphere, the only thing you can do is accelerate, decelerate. And therefore there is inertia, and therefore there is autocorrelation on the physical and transition risk factor. Note on the economical risk factor, there is no autocorrelation. Huh? If you look at because it's a short-term model, and it's also the reality when you have a financial crisis or a crisis in 1 year, you can perfectly recover the year after. We had a big crisis in 2008, and in 2010 it was all back great. So on the economic risk there is no autocorrelation, and it's a big problem that on climate risk we have autocorrelation because correlation is never good for any climate any risk assessment. But it is a macro stuff. At the micro level, if a particular bank finance the transition of their customers, we consider that it has no impact at the macro level. We consider that none of the bank is big enough to influence globally the situation. So at the micro level, what the bank will do is reduce its exposure of their banking book to the global risk factor. So in a sense, it can fight against autocorrelation by shifting faster to less exposed assets, but it will not influence the global risk factor, and therefore will not influence the autocorrelation.
That's perfect. Thank you.
It's a macroeconomy, microeconomy. It's always different world. Yeah. Any other?
Sorry, we have 3 more questions here, Jean-Baptiste, for you. They're all quite interesting, so let's try and cover them all. One from Boris about how can you translate the cumulated loss in terms of climate risk spread, and what is the order of magnitude versus the credit spread?
So to translate, I mean, it's kind of easy. It's just from a mathematical point of view, I would say. You calculate the marginal impact of a new loan on the global exposure of your portfolio. You recalculate the unexpected loss, and the difference is how much you get do you earn in terms of reduction of the unexpected loss. You can quantify the value of the unexpected loss, translating into capital charge, and then you can get the cost of capital. That gives you a dollar value for the reduction of the unexpected loss. And then you make sure that this dollar value is shared, let's say, or bring back to the customer. So that's easy. It's exactly what banks are already doing under the concept of KVA. I mean, if you are familiar with this concept, which belongs to the XVA family, when you price derivatives, because derivatives has a cost in capital, you want to reflect back the cost of this capital to the pricing of the swap. So it's exactly the same concept. It's a KVA, but the K here is a climate adjusted capital coming from the impact on the unexpected loss. Then the magnitude of the benefits it depends potentially from the situation of the bank. It also depends on when you are and what is the duration of the loan, because it will depend on what is the intensity of climate risk factor versus the economical risk factor. And then it will also depend on the type of the customer. So obviously, if you have triple C customers, the price of the loan will be much more impacted by the idiosyncratic risk of this particular customer, which is in a bad financial situation. And therefore, the impact of systemic factor might be negligible. However, if you have a AAA customer, so which would be essentially driven by systematic risk factor, I mean, then the impact can be quite substantial. So it depends on the situation. But the good thing here is through, again, this concept of KVA, capital value adjustment, we can have a mathematically consistent way to calculate it for a specific bank, for a specific loan, with a specific rating, a specific duration, and so on.
Okay, thank you. Let's grill you on a very interesting and technical question here from Scott. Jean-Baptiste, on the how do you apply the NGFS scenarios? How do you translate them to the factors models to show the final result? That's a good question because I think, if I may say one word on that, is that it highlights the consistency of what we are trying to propose here between the NGFS scenario used for stress test and the NGFS scenario being used to calibrate the macro factor model of the CERM.
Yeah, exactly. So it's a very good question indeed. It's a question. So we have these scenarios, can be NGFS, can be MPCC or whatever. And those scenarios, they are qualified, hot house, disorder, orderly, blah, blah, blah. In order to somehow build up a relationship between, let's say, two stress tests here and the distribution, what you need is first to consider not the distribution of a specific bank, but the distribution of the economy, because the stress tests are not specific to a bank. It's the stress test on the planet, on the global economy. So that's the first thing you need to do, and for that, it's very simple. On the model, you just put at 1 the exposure. As I said, 1 means aligned with the global economy, and you build up the distribution of the global economy, kind of the average of all the banking book of all banks across the globe, in a way. That's the first thing you do. And that gives you this kind of distribution, which are driven by the various parameters. And then what you need to say is, okay, this stress test, this NGFS stress test, hot house, you need to translate the hot house wording, which is just a qualitative thinking, in terms of what is a quantile. Because mathematically, hot house means nothing. What matters is a quantile. And as a quantile means, let's say, okay, hot house, it's bad, so it is, let's say, 3%. So it is quite on the right side. So just have 3% weight on the right side of this quantile, and that's what it means. And then you make sure that the bar here, which corresponds to 3%, so 3% on the right here, fits with the bar of the NGFS in terms of loss. And that way you have kind of aligned full distribution with the stress test. Another way to say it is you can consider the stress test as being one Monte Carlo pass across a full distribution. and you have mathematically defined what outhouse mean. Which is, does it answer your question?
So, thank you.
Sorry,
Last
is my-
question. Sorry, go ahead, Scott.
Yeah, sorry, is my mic on? Yeah,
Yeah.
thanks, Jean-Baptiste. Yeah, I know there's a distinction between stress testing with a single scenario and you're getting an unexpected loss distribution. So you're simulating, I assume, the region and sector factors like you lay out in your paper, which is the framework we've been working on for 20 years, right? So
Yes.
you're using these kind of top-down betas for physical and transition, and you're calling those global. So you're simulating the region and the sector you're simulating the factors to get the unexpected distribution, correct?
Yes, exactly right. With 3 factors on top of economic, which is a standard regulatory factor, plus physical risk and transition. And the reason why we have to add those 2 factors is because they don't have the same mathematical structure. Economic risk factor is stationary, can be observed backward, whereas climate risk factors is not stationary, cannot be observed backward, so you need a long-term forward-looking approach.
Yeah, that's fine. I understand that. Are those betas applied to the same to each of the regions and sectors? Because you have a global beta. So
that's right. On the sandbox, as I said, I mean, we simplified and we just apply a global single beta to take your word. In reality, banks will break down by region, by sectors, in such a way that have specific beta by region and by sector to reflect the detailed reality of their book, and also reflect their ability to rebalance from one region to another region and from one sector to another sector. But that requires a more sophisticated implementation, if you like, which cannot be done on the sandbox publicly available.
Thank you, Jean-Baptiste and Scott, for these discussions. Letana, maybe last question, Jean-Baptiste, and then we need to let people go, if I may say so. The question on the horizon and the fact that the traditional economic capital measures are 1 to 3 year times horizon, and we're looking here at 50 years. So how do you achieve 50 years versus the traditional economic capital model, which is a fair question and a difficult point to solve indeed.
So by the way, on stress tests, climate stress tests, there is a short-term stress test and 30-year stress test typically. So the regulator on the stress test framework already acknowledged that you cannot just have a short-term view; you need to have a long-term view beyond the horizon of the weighted average maturity of a banking book. Here, I consider 50 years. It could be 30 years. I mean, it's a parameter of the model. You can change the horizon and put 30. And the way it's done, I mean, it is through those parameters I described during the demo. So we have a stochastic diffusion equation, which mathematically looks like a bit what we use in capital market to price a stock option. So we diffuse the price of the stock. Here we diffuse the risk factors. As I said, it's an acceleration model to reflect the fact that there is inertia due to climate, due to carbon accumulation in the atmosphere. And thanks to this diffusion model, we can extrapolate step after step. So we have 1 step per year. So step after step, we can extrapolate how climate may change and how transition effort may change over the next 50 years. So it's a model. As any model, there is parameters, but it's a risk model, meaning that we do not say it will change that way or it will change that way. We say it will change that way with probability X, that way with probability Y, and so on and so forth. Full distribution of how climate may change and transition effort may change over the next 50 years, defined with the stochastic equation. Does it answer your question?
Does it? I'm not sure it fully does. I mean, the question is really about economic and how we're gonna embed the total curve into the one year horizon of the current economic and framework.
On the current, I mean, for short term, the model is not designed for short term. So on short term, you keep you keep the model as it is today, and then you have the stress test on the short term, which tells you what's your exposure against extreme weather event or extreme event. Here, the idea is to have a long-term modeling, which is consistent with the current IRB model, because we keep the economical risk factor, but it's just the economic risk factor because it is independent year after year. You don't bring any information by expanding it over 50 years, because every year is the same, and every year you forget the year before. It's a Markovian stuff, so it doesn't make sense. It's not useful if you have economic risk factor backward looking. It's not useful to spread over 50 years. That's the reason why the regulator today only asks a short-term calculation. But because climate risk is evolutive, you need to extend the horizon. Again, for the economical risk, it does not change anything because it is independent year after year. But for physical risk, because you have the dynamic and this inertia, it changes a lot over the time.
Okay, thank you. I think that concludes the presentation and discussion today. I want to say one more word just to the participants that you know, our next frontier here is to put this code into an open source format for sharing and letting the community add on it, and it takes work, and it takes a little bit of infrastructure and a lot of support to steward the open source code properly. So if you're interested to get involved into that project, into this open source platform that we would like to develop, please reach out to me or to Shirin, including if you want to contribute directly to this sandbox. I think, Shirin, you're open to that idea too, if I may. And it would be really great to see this, you know, the community building around this approach. Thank you, Jean-Baptiste. Thank you, Shane. Thank you all for your attendance. I hope it helped, and see you soon, probably after the summer. Have a great summer, everybody. Bye-bye.